Welcome to Excel and Finance video number 17. Hey, if you want to download this workbook or the PDF file that we're going to use, just click on the link below the video and you can download the workbook, all chapter 3 stuff. Hey, we're still in chapter 3. We're doing ratio analysis. We get to talk about leverage or solvency ratios. Very important. They'll help us figure out whether someone might have too much debt. Leverage just means how much debt do we have. Solvency, same thing, but slightly different point of view. Do you have enough money to cover your expenses and debt? Insolvent means that you cannot pay off all of your accounts that you owe, and you're probably headed for bankruptcy. The variables we're going to use for all these calculations are assets, liability, and owner's equity. And we're going to tend to use A for asset, D for debt, and E for equity. Now, the first ratio, total debt ratio, is just all the debt divided by all the assets. Total liabilities, total assets. We're just going to use D over A. Now, what does this do? We talked about ratios before. Whenever you do division, you keep a 1 here, $1 of asset. And then whenever you get up here, let's just say you get 50 cents. 50 cents of debt for every one asset. If it's 50 cents, the other side is equity, right? So 50 cents equity, 50 cents debt. So it means, the meaning of this, D divided by A, is the amount of debt for every $1 of assets. Generally, above 50 cents is not so good. When you get 50 cents exactly, it means it's all of the assets are funded with half debt and half equity. Now, again, it always depends. You got to look at the situation. Sometimes above 50 cents is just fine. Sometimes below is not fine. Now, let's just think of an example here. During the financial crisis, some people had $40 of debt for every $1 of equity. So this would be 40 divided by 41, which is almost 1. So the closer you get to 1, the more debt you have, the more trouble you are in. Bear Stearns, for example, had this ratio would have been 40 billion or trillion, or 40 billion divided by 41 billion. Pretty close to the number 1, so probably not very good. Debt to equity ratio, slightly different point of view. Now we're comparing the two funding sources, right? We buy our assets with either debt or equity, so we get the cash from either one of these. So now we can compare these. Again, the same thing. If you keep the 1 here, $1 of equity, this means for every $1 of equity, how much debt do we have? Generally, above 1 is not good. Well, wait a second. If it's 50-50, right? 50 divided by 50. That means all the assets are half financed by debt, half financed by equity. So that would be, as soon as we get more debt than equity, probably not so good. Now, this is the one where, when we did this division for Bear Stearns during the financial crisis, 2007 to 10, we got the number 40. So when I say generally above 1 is not too good, right, for most businesses, it's not. But when you get up to 40, that's just crazy, right? Now, banks are usually have quite a high number here because they're in the business of taking deposits in, and most of what they have are liabilities. So there's some businesses like banks where you're going to have a much bigger number. But 40, probably not too good. By the way, federal regulation in the 2000s, I forget exactly when, used to be a much lower number, and it was moved up to allow banks to get 30 and 40 times as much debt as equity, only in the 2000s. But after the financial crisis, people reduced that amount. Another important ratio. Remember, these are all leverage and solvency, and we're either using assets, equity, or debt. So this one is assets divided by equity. Now think about this. Assets are everything we have, right? And we either bought it with debt or equity. So when we have equity on the bottom, this number, if the firm has 0 debt, then it's 1. if it has any debt at all, it's always going to be more than 1. Now, equity multiplier, the reason why it's called multiplier is because think about this. And we'll see lots of examples in just a moment. If you invest $1, but the company also has $1 of debt, then it would be 2 divided by 1, right? So it's as if the person who's investing can invest $1 of equity, but they get to buy 2 assets. So there's an advantage there. The extra assets from having debt are helping to earn a return. And also there's the tax deductible advantage we talked about. So this ratio means for every $1 of equity, how many assets did we have? Now, we're going to do this over in Excel, but let's just think about the relationships between these ratios. If you know debt to asset, this is the debt ratio, this one right here. Let's just say we know it's 0.2. Well, 0.2 we can kind of do in our head. That's 2 divided by 10. So then if you know this, you can deduce this, right? dA 2 divided by 10. Well, now if you know this, you also know equity, right? Because all the assets are bought with either funds from debt or equity. So if this is 2, that means equity has to be 8. And then from that, you can also conclude, do the debt to equity. You got the 2 and the 8. You know it's 0.25. And finally, just from this original decimal here, we can also calculate this. As soon as we know equity, we can do asset to equity. That's not the right answer right there. This is cut off. This PDF is cut off. It's not 1.2, it's 1.25. I redid it down here. See, assets divided by equity. It's 1.25. So this is 1.2, and then there's a 5 right there. 10 divided by 8. Now, we do that, but let's look at this with the numbers, right? So if you know this, you can calculate the rest. Anytime you know the A and an E or the A and a D, you can figure out all the related ratios here, doing a little math. Let's look at something else. We want to notice something. Equity multiplier. So if you have any debt at all, this is always going to be greater than 1, because $1 equity plus some extra debt will give us more assets. So always greater than 1. But this, let's just think about this. What's assets? Equity plus debt. So we could write it that way. Well, we can break this apart. Since this is addition, we can rewrite it as this with an E in both of the denominators here. Well, anything divided by anything is what? 1. So 1 plus debt to equity equals the equity multiplier. So oftentimes, if we have this number, we can just immediately figure out what this is. Thus, if we know that debt to equity is 0.25, we don't even need to go to the balance sheet and do this calculation. We just go 1 plus. And later in finance, you will see a lot of, there are many calculations that do exactly that. You have debt to equity, and then you add 1 to it to get the equity multiplier. Finally, there's 2 other leverage or solvency ratios. Abbott divided by interest. This is just how many times over you can pay interest, right? Because this is our earnings. We put this in the denominator, and then for every $1 of interest, how much earnings did we have? If you have a lot of depreciation in your business, then you definitely want to add depreciation. So Abbott plus depreciation divided by interest. All right, let's go over to Excel. And we're going to click on the sheet, Whole Foods Market International Leverage, R for ratio. These are actually financial statements I got from the SEC, and then condense them for our purposes here. Now, we're going to do a bunch of calculations, and I don't want to keep going back and forth. So I'm going to get all of our numbers up here and then blow up the screen so it's easy to see. Notice we really only need, debt, assets, equity, but we also need these 2 items from the income statement. We need 2006 and 5. So for 2006 total liabilities or total debt, come down here. There it is right there. Now notice that's a relative cell reference, right? So I can copy this over. And the reason why is because that just moves over to there and points there. Same thing here. Total assets. I'm going to go right there and then copy it over. You can see when I put this in edit mode, it moved. The blue box was there. And when I copied this over, it moved to there. Equity. I'm going to come down to get total stockholder equity looks like B39. And then I'll copy it over. Now we need to get a couple numbers for 2006. Abbott equals, and then earnings before. And then interest. Wow, not very, wow, look at this. Lots of interest. Boom, must have gotten rid of some debt. All right, so let's go ahead and calculate our ratios, 2006, 2005, and then we'll look at how they changed. Remember, ratios in isolation usually don't tell you much. Or put another way, they tell you much more if you look at the ratios as they change over time or as you compare them to other companies or industries. So we want debt ratio. So we're just going to take for 2006 our total debt divided by our total assets. This means for every $1 of asset, we have 0.3127. So 31.27% if we formatted that. So if we went like this and then increased the decimal, right? I'm going to get rid of that formatting, general. It also means 31.27 cents of debt for every asset. So every single asset has 31 cents of debt, and the rest is equity, right? 69 cents. All right, let's go ahead and do this calculation. Oh, wait a second. No, notice this formula right here is saying this many up and that many over. Blue box divided by green box. So when I copy this over, the blue and green box will move to here. Right? So there we go. So 2005, we had almost 28 cents of debt for every asset. And now in 2006, we have 31 cents. So the debt went up a little bit as a percentage of total assets. Now we want debt to equity, and this is a very common one. We're going to take for 2006 debt divided by equity. So for every $1 of equity, there is 45.5 cents of debt. Now I'm going to copy this over. So we went from 38 cents of debt for every $1 of equity to 45. Now the equity multiplier. We can do this two ways. Let me do it the long way here. Equals total assets, so right there, divided by our equity. Again, this tells us for every $1 of equity, how many assets were we able to buy. Every time we invested $1, we were able to buy $1.45 of assets. Now, that'll work, and we can copy that over. So we went from 1.38 to 1.45. Oh, I was going to make this bigger. I'll have to edit this and make that little bit bigger. So Alt-WG. That was just a quick way of going to zoom to selection. If you highlight something and go zoom to selection on the View tab, it will zoom in. Now, once we know debt to equity, we simply can just add 1. So I'm going to say equals 1 plus debt to equity. And why are these different? This is formatting. I'm showing fewer decimals. If I were to highlight all of this right here and apply the general, you can see then the decimals are exactly the same. But however you want to do it, we don't need to see all those decimals. How about we go like this? There we go. That's a little bit better. Or maybe even one more. But you can see those decimals are still there. We're just not seeing them all. So 1.45. So 1.38 to 1.45. So a little bit more leverage. When you take on more debt, you certainly are able to buy more assets. Again, the meaning of this is $1 of invested equity, and we got $1.45 worth of assets. Now let's, again, these are help us look how much leverage there is, how solvent they are. Well, this is even a more specific. This says how many times over can we pay interest. So let's try and do this one, whatever the Abbott is, and this we're just doing 2006 divided by our interest. Wow. So we can pay it many times over. You can see for whatever reason we had very little debt. So during this period, we probably had some transition of, if we go look at our debt, so liabilities, I went from 5 to 6. So long-term debt, so it definitely went up. And this is total debt, so it's all of this right here, accounts payable, other current liabilities. Definitely went up, but for whatever reason, we did not pay a lot of interest. Maybe a bunch of interest. We paid off a bunch of debt or paid the interest in the period before or something like that. But that's quite huge. Let's go ahead. We don't have the other. Oh, yes, we do have the other numbers. I forgot to put them here. We can just drag them over. There we go. So this is probably a more normal one. I can drag this over too. Right? So now this is taking Abbott divided by interest. And so now we can pay 107 times over. So this is an anomaly. There's something odd going on here in our timing of paying interest. Now cash coverage, we're going to have to do earnings before depreciation, interest, and tax. So we're missing one number here. I'm just going to do it this way. Equals, and then in parentheses, Abbott minus, and I'm going to go find the depreciation over here. Amortization is another word for depreciation. So I have that. Oops, I'm sorry. Add back in. Remember, non-cash, so we have to add it back in. And we're going to divide it by our interest. OK, so all the boxes are in the right place, the little green, blue, and purple ones, lavender ones. So there we have it. This is probably more realistic, and probably want to go to a few years back and see, but there's just an anomaly in this period right here. But again, they have the ability to pay off their interest many, many times over. So the meaning of this, creditors looking at this are going, man, they're in good shape. And this is under 0.5, which again is generally a good sign. So it looks like in terms of their solvency and leverage ratio, they're doing great. Now, to just see the relationship of these different ratios, again, we saw this in the PDF. If you know that the debt to asset is 0.2, and we could, it's 0.2, we can from that conclude a number of things. Equals 2 divided by 10. Right? So it does require that you know how we got a 0.1. This is just roughing it, right? We know that 2 divided by 10 gives us 0.2, but it gives us not the exact numbers, but the relationship between them. Right? So now, if we know that, let's just fill this out. Actually, these cells shouldn't be green because we're going to have no fill. I put no fill there. Well, if debt is 2, and total assets is 10, then actually we can put some green right there because that means a formula. If you know that, you can just go assets minus debt equals our equity. Now, if you know this, we knew the debt to equity. We have all of our numbers, so we can simply say debt to equity equals our debt to equity. Our leverage ratio, our equity multiplier, we simply can go 1 plus. So just in analysis, a lot of times you just do not have complete information. So seeing the relationship between the numbers and understanding how to take one single decimal like this and then, guesstimate. They're not the exact numbers, but they give us the relationship, and then from that we can deduce the rest of these ratios. All right, we'll see you next video.